Dear viewers, interesting events have unfolded over the last few days. Fitch has downgraded US credit rating. Morgan Stanley recently upgraded India's outlook to overweight, suggesting that we are entering a long growth phase. The world is acknowledging that the elephant can dance and the dragon's fire is losing heat. And guess who gave India's growth story the big thumbs up? Well, it's none other than China. China's top state-run bank and biggest lender has joined India-dedicated investment fund, citing that India offers the best opportunity for a double-digit growth. While China itself is slowing down after a spectacular growth phase which was triggered by manufacturing, capex, and infra revolution lasting decades, it seems to be India's turn now. So in this video, I'm going to talk about a small cap stock that you should have in your watch list if you're interested in riding this capex and infra wave. In this video, I'm going to talk about a small cap stock that you should have in your watch list if you are interested in riding the capex and infra wave. Well, the stock in question is Sangvi Movers. Headquartered in Pune, Sangvi Movers is the largest crane hiring company in India and Asia with 55% market share. It is also the sixth largest in the world. It has a fleet of over 400 medium to large sized cranes ranging from 22,000 metric ton, over 130 operational job sites in India. Sangvi Movers is present pan-India with its depot network spread in more than 10 states. Now cranes are critical for infrastructure theme to play across industries such as wind energy, power sector, refineries, fertilizers, oil and gas, steel, metal, cement, metro and EPC projects. Sangvi caters to all of these, with revenue from wind sector accounting for the biggest share of 48%. As green capex is one of the identified pillars in the budget presentation this year, if this theme indeed takes off, stocks like GHCL and Sangvi Movers deserve to be a part of your solar and wind energy stock watch list respectively. By the way, do check out my video for GHCL's role as an enabler in solar energy revolution in case you missed it. The link is shared below the video. Now coming back to Sangvi Movers. As highlighted in one of its con call, wind energy added 2.3 gigawatt of capacity in FY23. In FY24, the management expects country to add 4 gigawatt more. The company has around 65 to 70% market share in the wind energy market. The order book as on 1st August 2023 to be executed in FY24 is 4.5 billion, up 40.6% year on year. This is the highest order book in last 5 years. Now that the infra cycle is on an upswing, the company is in a good place to make the most of it with its lean balance sheet and surplus cash to capitalize on growth opportunities. The company has a gross block worth rupees 25 billion of cranes. Its capex guidance for FY24 capex is 3 billion rupee, of which 2.4 billion was done in first quarter of FY24. 70% of the capex is debt funded. This is higher than the combined capex in the last 5 years and will reflect in the top line growth, with most of it going to cranes. This capex is backed by multi-year project orders from core sectors such as refinery, petchem, power, renewable, and construction sector. The management expects utilization level despite such high capex to be over 80% due to multiple cylinders firing. The maximum utilization that the company expects on its cranes is 90%. Now, in the previous upcycles, the blended yields had been more than 2.7%. This is an indication of average monthly rental income that the company earns on its cranes investments. The yields in that range were on account of some benefits and overtime and use of old equipments in those years. Given the fast project execution cycle, realistic yields this time are expected to be just a little more than 2%. The yield for June 2023 quarter has improved to 2.21% as compared to 1.97% for FY23 and 1.71% for June 22 quarter. Rental yields are flat across the sectors. As such, the cranes added would be fungible across sectors. Coming to financials and valuations, Sangvi's debt to equity is 0.34 times, which is well within the comfort zone. The receivable days are expected at 90 to 110 days. The debt to equity, as I said, is 0.34 times, and the return on capital employed for FY23 was at 15.2%. The ratio of cash flow from operations to net profit is 2.3 times, suggesting strong earnings quality. The stock is trading at a PE of 20 times and a PEG or price earnings to growth ratio of 0.7 times. Now, one thing you need to keep in mind is that Sanghi Movers is a cyclical play. Prior to Infra pickup last year, the stock had been in a down cycle. However, there are some ways in which the company has made the business more resilient. First, its exposure to wind sector alone has come down from 75% in FY16 and FY17 to just 48% now. In the earlier cycles, it resorted to huge debt-funded capex of up to rupees 7 to 8 billion in FY16 and 17 to mainly cater to the investments in the wind sector. And then the downturn in the economy, especially in the wind sector on account of regulatory changes from bidding tariff to reverse auctions, led to a cut down in wind installation. With that policy scrapped now, wind installation has picked up momentum. More importantly, the company has diversified its business exposure significantly beyond wind sector. In this cycle, due to the above factors and healthy liquidity and low debt on the balance sheet, the company is better placed to play infra cycle, which is still young. All in all, I believe Sanghi Movers is a great enabler of the investments unleashing in the Indian economy, and it makes a cut for the watchlist of small caps that could ride the capex wave. Now, do note that this is not a recommendation on the stock. With this, I've come to the end of this video. If you liked it, do press the like button, and in any case, I would appreciate your feedback. For more such updates and video alerts, do subscribe to Equity Master YouTube channel. Thank you for watching. Goodbye.